If you watched my video on stock market predictions for 2023, you saw that I laid out 3 possible scenarios. Well, since the posting of that video, a lot has happened. And one of the greatest investors of this generation has publicly stated that he thinks one of those scenarios is likely to happen, and that is influencing how he is running his hedge fund. Who is this investor? His name is David Tepper. He is the founder and president, the CEO of Appaloosa Management, which is a hedge fund located in Miami, Florida. Tepper is considered one of the most successful investors in the world, having made billions of dollars investing in the stock market. His current net worth is around $15 billion. And that net worth is generated primarily through his investments that he has made over the last decades in the stock market. Now, David Tepper is mostly known for his aggressive style of investing and his ability to make high profitable trades. He tends to be optimistic. He tends to be bullish, and he tends to make his money on recovery and growth.
I'm like generally an optimist. I have just the way I just have that sort of lean that way.
Some of his most notable investments include in 2009, he made a profitable bet on the recovery of the financial sector after the great financial crisis. He took on large positions in Bank of America and Citigroup. And if you take a look at those charts, you can see that that was a very successful investment. He bought when everyone was too afraid to buy into those stocks. Another great investment he made was in 2013 when he took a large position in Netflix, which ultimately became a super growth stock and had massive returns. In 2017, he made another good investment buying a large stake in Amazon. And as you can see, Amazon from that time has grown tremendously. He also bought a stake in Tesla in 2020. That's right around the time where the momentum and FOMO in that stock was at its prime. And the stock had a massive move to the upside, which is falling apart in this bear market. So as you can see, he makes his money betting on stocks, not betting against them. So when he says he is bearish, you better listen. In the most recent interview with CNBC, he laid out 3 main points. Point 1 is that the Fed still has a lot of work to do. Financial conditions have not come down enough, and the Fed is not happy with where they're at right now. Mortgage rates are easing because the bond market is retracing. Junk spreads are also down, meaning investors are again willing to take on more risk. And the yield or the interest rate on the 10-year treasury has come down as well, which helps stocks. He also mentioned that the stock market returns since 2019 are about average, which isn't really causing too much economic pain. The second point that he made is that central banks are extremely hawkish. They're telling us what they want to do. The Federal Reserve has been very clear in its message. There's also global tightening like we've never seen before, with a rising rate environment here in the United States and elsewhere, and also quantitative tightening happening here and elsewhere as well. And inflation, while it is coming down from its peak, is still a long ways away from 2%, which is the Fed's target. So if the Fed is telling us that they are going higher with rates and they have access to all the information that everyone else has, and something has to give with the bond market, which is pricing in a Fed pivot in 2023. The third point that he made is that he is leaning short. He is leaning short stocks, and he is also leaning short bonds.
But for me, as a hedge fund manager, I'm going to lean short. I'll be short bonds, and I'm not a great. I'm like generally an optimist. I have just the way I just have that sort of lean that way. So it's like I'm not. I would probably say I'm leaning short on the equity markets.
Right.
So right now, because I think I think the upside downside just doesn't make sense to me when I have so many people telling me, so many central banks telling me what they're going to do.
Being short bonds means that he has a bet that he thinks interest rates are going to continue to rise. And that falls in line with his view that the Federal Reserve is saying what they're actually going to do. Because the cheaper a bond is, being short a bond, the higher the interest rate or the yield is for that bond. The fourth point that he made, which is a very important point, is that market multiples are just too high. The current price to earnings multiple in the S&P 500 is around 18. Why do we have such a high multiple if rates are going to go higher? Coming out of 2009 in a very low rate environment, we had multiples of around 12. If you have an estimated earnings of 225, which is way too high in my opinion, and is just an example he threw out there, and you tack a 16 price to earnings multiple off of those earnings, you have the S&P 500 at around $3,600, which is less than the current price right now at around $3,800. The current earnings on the S&P 500 is 190. And in this environment with a potential recession right around the corner, it's not unrealistic to think that we have a low growth, no growth, or even an earnings decline. But let's say that we see a 5% growth in EPS for the S&P 500. That would put us right around 200. If you tack a 16 price earnings multiple off of those earnings, you have the S&P 500 at around $3,200. And that's a 16% decline from the current price. So there's a lot of risk still embedded in the market. David Tepper is basically laying out outcome number 3 from our prior video of the stock market predictions, in which we see higher rates and for longer from the Federal Reserve. There's more competition against stocks because bond yields are higher. So as a person who is managing your money, you can get a pretty good return risk-free in the bond market, so you take money out of the stock market, which would result in a drop in the prices of stocks. And on top of that, because we have a higher rate environment for longer, there is a looming potential recession still hanging over our head. And that means we cannot price getting out of a recession until all of that is resolved. It for sure is not the best market to be long. And that's why, as a hedge fund manager and one of the most successful investors in the world, he is currently leaning short. While typically he is very optimistic, in this environment, it is so reasonable to be leaning short. But that's my opinion at least. Comment down below higher rates if you think they are going higher for longer. Comment down below recession if you think we're going to get a recession in 2023 and the Fed will have to pivot. And if you would like to support this channel, you can do so by joining the Patreon. It's super cheap, priced at only $5 a month, and it provides you value as well. You get access to this private Discord server. There is a dedicated channel in that Discord server where I post all of my live trades. And here are some trade results of trades that we have posted publicly over the last couple of months. Members will also post their trades in a dedicated channel as well. And in other channels as well, we will provide news on the stock market. We will provide briefings, my personal opinions on the market overall, and we will have discussions on trades and investment ideas. That wraps it up for this video. I thank you so much for your time. This is We Are Investing, and that's a wrap. See ya.